Welcome back to another episode of Money Moves.
What's
Mr.
up, guys?
Breedwell is back from Hawaii.
So, yeah,
I
sorry,
didn't-
I
I
was
didn't-
caught in that tropical storm.
I didn't know what to talk about last week outside of real estate.
That's
had
what
to-
you got to talk about.
I had to
man.
give everybody my 20 laws of real estate investing success, which actually a lot of you reached out and got the list on that. So that was fun. We talked about Trump's new tax plan.
Yep.
And the proposal for indexing,
I like that.
which I thought that was great. I think everybody who owns real estate will win from that.
Yeah.
But when it came to the stock market, I was like, I don't even know what the fuck to say here, so I'm going to defer to next week when the big dog is back in the house, and we've got a great show for you guys today. Big news on the Treasury buyback. We'll talk about whether or not that impacted the market and really what those implications are. We've got Nvidia earnings, which
That's going to be
when
the
you got a
big
top
one for the
five
week.
juggernaut like that, that's always, I'm assuming, going to move the market. And we'll get your prediction on what is expected there. We got PCE data coming out and really how that data is impacting rates and whether or not we're going to see a hike, a pause, a cut, as well as Jackson Hole is going on this week.
Yep.
That always has big implications. That seems to move the market a little bit.
It's kind of just, it's the purest definition of the good old boys club. But politics and business collide, and you really get that. And you get Fed Warsh. That's going to be his. It's kind of also because it's his first speech. You're going to get that big explosion in the market one way or the other. That's typically what happens on this.
So
meeting.
we'll kind of get your thoughts and take on what's going to be discussed there and how the market is going to respond to that. If you are any bit invested in crypto, this might be the beginning of the bull market. The bear may be coming to an end. The bottom might be in. We'll talk about that. And we've got some real estate data and updates. One of the biggest things that I have been discussing with a lot of people right now that are trying to get into real estate ownership is there's really 4 different types of capital that you can leverage when it comes to real estate. And you have all of them, not just money. So we'll talk about those 4 and some of the non-negotiables for those of you who are raising capital for whether it's your real estate deals or your business. There's some key things here that really separate the people who raise a shitload of money and the people who really struggle to do that. So we've got a good show for you guys today. Many of you who are tuning in live, what up? Let us know where you're tuning in from. Drop it in the chat. This is one of the reasons why we love doing the live stream is we get to interact with the chat with you guys. So let us know where you're tuning in from. Why don't we kick things off with the the stock market, and just do a quick little overview. One of the things that we're trying to do is obviously just give you guys an insight as to the data that we follow, that we track. One of the biggest things every start of the week, you and I are always talking about this going back and forth, is the U.S. economic calendar.
Yeah.
I always just pull it up on Market Watch. Tone, you can pull that up on the screen. So this week, really not a ton on the agenda except for new home sales came in as a really shortfall from where they were hoping to see that. I've got some more data around what that's going to look like. And rents are falling, but that might be not necessarily the good news that people think it is, and specifically how this ties into home builders and supply coming onto the market. We'll get to that here in a little bit. Today, we had the S&P Case-Shiller Home Price Index. That came in lower. We got the big dog tomorrow, which is PCE. For those that don't understand what PCE is, why it matters, explain this as if we're a fifth grader.
Producer cost expenditure is just how much does it cost a company to get what's the additional cost, the margin squeeze off the top that's going to get a product to consumers. Essentially, if producer costs rise, they typically pass those through to consumers. So it's a precursor most of the time for CPI. So a lot of people are looking at precursors for CPI going up or down. That's why this report would hold a bunch of weight. Last time it came out, it was negative 0.1. I think the street consensus is 0.2 raise. We're at a 0.1 or flat.
Yeah, it looks
So
like month over month, we're looking at, Tone, if you pull that back up, we got 0.1%.
Yeah, so, okay, maybe it came back in line over the past few minutes, but we're looking at for it to be either flat or in line. But year over year, it should be down. Yeah, exactly. It should be down by about 0.1.
And what does this tell us about, why does it matter? What does this tell us about the state of businesses, the strength of these companies and their earnings, and how their ability to operate is being affected by inflation, some of the rising costs that we're seeing kind of across, the world right now? Like, why does this really matter, and how does it impact the average investor?
Really what it does is it takes any juice out of the market for a rate hike, and it also keeps pauses in line. So when we're looking at futures over the past couple of weeks, it kind of looked like a wild staircase. You had rate hikes for the next couple months, then huge cuts, then back to a midline. Now it's more through the end of the year, the next 2 meetings, there's a prediction that there's just going to be pauses. And I think that's going to keep coming in line as we get closer and closer to meetings. And when we see Kevin Warsh speak at the next meeting, I don't think he's going to give us any heads up like he's been doing on what's going to go on. And I think it's going to take more and more octane of people guessing so much what the Fed is going to say to move the market and focusing more on the things that matter, which is CPI data, spending, GDP data, which also comes out this week, which is expected to go up, and earnings. Earnings is really the most important thing in the stock market.
So we'll get to Nvidia here in a second, because obviously that is going to be a market mover.
It's going to be the most important thing for the week.
So talking
100%.
about rate hikes, cuts, pauses, if you want to pull this up on the screen, you talked about PCE data impacting this.
Yeah.
The last couple data prints that we've seen around inflation and jobs and a lot of the stuff that obviously factors into what the Fed decides to do. Break this chart down for us. So, like, what are we looking at here?
Essentially, the blue color is where this is the Fed futures. So this is people essentially putting money on futures contracts of where the market's going to move. Oops, went away there for a second. There we go. Right now, there's about a 63.4% chance of a pause at the next meeting, and then the hike to the right of it says about a 36.6% chance. So right now, you have a stronger futures lean towards a pause than you do a hike. Moving forward to the October meeting, into the month, same thing, 51% pause, 42% hike. You even have a bigger hike if you go to the far right, so there's a 0.5% right there. And as you see, from there on, it's straight down. What I think will happen is that blue bar is going to keep moving over to that 350, 375 range where we're currently at. And then you're going to start seeing more weight shift from the hike side back down to the cut side, moving into and through 2027. I think if I say there's going to be a rate hike.
Yeah, don't fucking jinx this.
Maybe
bro.
I should say there's going to be a rate hike in 2027.
Yeah,
I'm just not going to say anything this year, because if I don't say anything, whatever happens on that one, I'll be like a real analyst. I won't be bullish. I won't be too bearish. I'll just be a little bit right.
No,
like
we like when
pores,
you just
man.
fucking throw your bold predictions out there. And, every once in a while you have to fall on your sword. But most of the time you're pretty locked in on this. So, obviously, from this chart, we can see that
pauses are in for the.
Any hopes of a rate cut this year and really going into next year. And we know that the data can shift quickly. Right. So, this isn't to say that this is, very far forward looking right now, but
it's so fickle.
But at the same time, we were seeing some percentages in these ranges that were getting people excited and hopeful, and it's really off the table at this point. And that is obviously going to pose a challenge for a lot of investors that are leveraging debt, that need debt. We'll talk, we'll go and take a look at the 10-year treasury here. But obviously things aren't getting cheaper and more affordable for people right now.
Not on the debt side. Yeah, not on the debt side. And then we have this kind of like ever steady conflict, whatever you want to call that, with Iran going on. And so we don't really have a lot of good things going for the affordability of things. For the bond market, for example, has been really sticky. Minus today, we had a bond rally, so yields dropped by about 1.3% today on the 10-year, which is really good. Just cost of capital is too high. I've said it for a while. I think the federal government is going to have to intervene in a cash injection type way of giving out money to investors where it's good, because mortgage-backed securities are a real thing. They are really a staple for the U.S. economy, and they help the stock market. They're going to need to figure out if rates continuously stay this high, with investors not used to rates being this high and not having penciled it in for this long, we're going to have to figure something out. Because if not, we're just going to have a huge, I don't want to say the C word, but pull down in the, I would not say residential, but definitely the commercial market. It's just going to suck. And then there's just going to have all these empty buildings sitting everywhere. It's going to look like a developing country kind of, which I don't think the U.S. government's going to allow it to get to. So in my opinion, what they'll do, they'll figure out some program that they use tax dollars to then reinvest back into investors like yourself or other institutional investors or mom and pop investors that have good balance sheets that can actually make the numbers work and get the kind of gas and steam rolling in the right direction until rates continue to go down. Because if they don't, and I don't see them going down anytime soon this year, the cost of capital is going to continuously stagnate the real estate market.
So this week, and that kind of really ties into what we saw with, Secretary Scott Bessent, they're really trying to do whatever they can. You can pull this up, Tone, to figure out how to get things a little bit more in line with where they want to see, specifically on the bond, the bond market. I think it was, they announced, let me go back to my notes here. So they announced that they were going to do $4 billion in treasury buyback.
Yeah.
Is that correct?
Yeah, which is kind of like, when a company buys back their stock and you see the stock price go up, when bonds rally, that's actually a good thing, because that means yields are going down. There's enough money pouring into debt that the demand is high enough, the yield needs to be compressed. So that's a positive. So similar to a stock buyback, when there's money injected into the U.S. economy via the Treasury or not, it's going to help bond yields come into line. So I think they're trying to do that. Well, I don't think. They're obviously trying to do that. But I think they're going to try to tool other things. And I think it was really interesting to see when they talked about filing the 301s. I don't know if you saw last week when he was on Fox News talking about the 301s. Those are the legal tariff documents that are filed with the the court that does that. I can't remember the name of the court. And the majority of those are still pending, but they almost always get approved. I mean, by every president that files them ever, they almost always get approved. So the ones that were reneged back, like the money that was sent back to all these companies like Target, like the reason they're holding that money and they're not giving it back to consumers or spending it on anything, that money is going to most likely go back to the U.S. Treasury. That's my guess. Because they're going to get those 301s approved and they're going to claw that money back. And I'm pretty certain the legal teams for all these corporations have told them that that's kind of the light at the end of the tunnel that's probably going to happen. Because once the 301's filed and approved, there is no overturning it. It is the law of the land. It's going to happen. So my opinion is that's what's going to happen on the tariff money. When that tariff money comes back, they can use that money to maybe do a lending program or re-inject it back into the bond market and continuously push yields down. So there's a lot of options, but I think they're waiting on getting those 301s through to use a lot of that money. So using other countries' or companies' funds to help bring our inflation down. That was their idea of buying our way or growing our way out of the inflation, and that's what they were really hammering on last week.
Yeah, because I know Bessent said basically they're going to do whatever it takes. I even saw kind of an interesting post, some kind of prediction that somebody was saying that Bessent is going to engineer a short squeeze in treasuries that will send bond prices soaring and interest rates plummeting. Do you think that is a potential scenario that we could see?
I don't know if it's a short squeeze.
Yeah, I don't know if that's the right terminology.
I think what we were just saying earlier, where there's going to be capital continuously injected into the bond market, similar to how they flooded the global market with cheap oil, and they're continuously doing that, and that's keeping oil prices pretty steady even through this conflict. They're going to do the same thing with U.S. debt. And the thing about U.S. debt is people want it. people around the world want U.S. debt. It's very reliable. Countries can bank on it. We give access to our market for countries for holding certain amounts and give privileges for that. So I think that that's what's going to continuously happen. And it's going to continue slowly but surely. And you heard Warsh say this in his last meeting. We're going to slowly but surely continuously pull inflation down and down. It's not going to happen overnight. But I think through the end of the year, you're going to see some huge and modest to huge progress in that direction. And I think at this point, we're at least making modest progress with the prior inflation data being flat or negative.
Yeah, well, they said they were going to buy back $4 billion. It looks like as of today, it was released that they've only bought back like $985 billion. I know this news definitely sent the crypto market pumping, which we're going to get to that here in a little bit. I saw this post on the Kobayashi letter, which I thought was interesting, right? This is somewhat historic intervention and them pulling the levers that they do have to kind of fight inflation to get things back in line with where they want to see it. So despite several announcements by the U.S. Treasury about imminent intervention, yields still won't fall. Let me pop over to this real fast. So the 10-year yield was higher than the pre-buyback boost. So it is interesting that
yeah, but it's retraced that.
I know we saw that the 10 years down to 4.623 today, so it did, come back a little bit, but nothing too meaningful. Reports, that he's saying he's going to do whatever it takes to lower yields. In addition to the buybacks, this could include short selling or selling short-term debt, possible elimination of long-dated bonds, and more. Meanwhile, President Trump even said that he could use the military to lower yields through it's unclear exactly how he's going to do that. Not sure how the military plays into that.
I don't either.
But the reality is that the Fed cannot cut rates in this environment, and the Trump administration knows that. So direct bond market intervention seems to be kind of the only card that they can play, at least right now.
And tariff money, I think, is the ace up their sleeve of what they're waiting on, so that they can put a ton of money into it, and nobody can say, oh no, this is, money that it's tariff money. So it can be used by the Treasury how they see fit. And if they put it into the bond market to make capital cheaper and mortgage rates go down, you're not going to see people complaining about that. I mean, you will see politicians and far left people complaining about that, but you won't see your everyday individual complaining that the mortgage rate is down. You'll see refis shoot through the roof. Earnings for banks will go up. Real estate will start to kind of crank again and get the wheels rolling. That, in my opinion, is what they're banking on, and I think it's highly likely that can happen.
Well, what do you guys think? Are we going to see this have a positive impact and head us towards a path of lowering yields and debt by the end of the year or headed into 2027? You think that we're headed into a little bit more of a sideways chop for some time? Or are we potentially going to see some rate hikes here? I'm always curious what you guys are seeing, your perspective on a lot of this stuff that we're talking about. So feel free to drop that down in the chat. Let's head over to Nvidia. So obviously one of the top 5 stocks of the entire world. It is a market mover. Anytime they report earnings, it either sends, shockwaves through the market in a positive way or in a negative way. We have seen, at least, today they had a great kind of little rally heading into the end of the day. Is this based on the market front-running expectations that they're going to have a really strong earnings report? Let's see, last 5 days they've been, down a little bit, so they retraced and recovered some of that. Obviously, they've been up pretty strong over the last month, and year to date, 13%. So Nvidia has been having some pretty large partnership, PR releases. They're doing all of the right things. Mm-hmm. What are you expecting tomorrow from their earnings and, short-term impacts, maybe midterm? What do you think this is going to do for the market?
I think that if Nvidia earnings are a beat, especially on their revenue and their EPS, I think they're trying to beat $2.05 on their EPS and somewhere around $93 billion on earnings. I think that they have a chance to beat those, and if they do, you're going to see not only them move up significantly, but you'll see the whole semiconductor space, the AI space, tech. You'll see bond yields rally, or bond values rally again, and yields continue to go down because that's a rate sensitive area of the market. Conversely, if they have a miss, that will put some negative sentiment in the market, and I think we could see some big selling and go into like a mini sell-off through the end of the day. That could be met with, big institutional buyers buying that up, being long. But my anticipation is we're going to have some positive news from Nvidia, and that's going to be the catalyst that people ride through the end of the week into Jackson Hole as well.
So let's talk about Jackson Hole real quick. When these guys get out to Jackson Hole, who's going there? What are they talking about? Obviously when you get the billionaires and the trillion-dollar companies and the CEOs all together, and like you said, right, it's the good old boys and good old girls club, that these are market movers. These are world kind of defining policies and conversations and relationships that often happen in these rooms. So what are some of the things that, from what you're hearing, are going to be on the topics of discussion? And is there any sentiment that's going to be taken out of that we're going to know about at this meeting? Or is this things that, they discuss and we just start to see and feel some of it as things kind of roll out into the markets?
Well, the theme for this year's Jackson Hole meeting is financial innovation. I believe it's focusing on payment processing and policy around payment processing. I think that leans very heavily on I think that's a really roundabout way to say crypto. So I think that's what the talk of the town is going to be. We have legislation pending that still has not fully passed or been signed into law. So I think the crypto legislation that's on is going to be what's talked about, how that affects businesses, how they want it to affect their businesses, and how they think it should work. There's going to be some highly influential people there from politics and from business owners. I think they have about 120 or so attendees. That's about the normal amount of people that go. My anticipation is it's going to be chatter about crypto until Warsh starts speaking. And then Warsh is going to kind of take the spotlight because people are worried about sticky inflation. So they're looking for some good guidance. I would say some dovish support that he gave last time, but he's not going to give too much, and people are starting to get used to that. But as long as he doesn't give any bad news, I think the market will continue to march toward slowly that 2% mark that it currently is. Or maybe one day I'll wake up from this nightmare and we'll raise the 2% to 3% like it's always been and just get back to things as normal. Because if that's the case, then everything is back in line and people don't think inflation is high and everybody's okay. So we'll have to see. But that's my anticipation. A lot of crypto talk moving into Warsh's speech, and then you're going to see the long-term end of the bond yield to the 10 to 30 year. They're really going to talk about the 30 year a lot. They want to see what the long end of the curve does. If he gives negative sentiment or hawkish sentiment as far as, hey, things aren't looking so good with inflation, I expect the long end of the curve to spike quite significantly, and then we'll see a pull up in the 10 and the 5 as well, and that's not good for mortgage rates.
Yeah. Okay, so S&P 500, give us a little recap. Tone, you can pull this up on the screen. A lot of people obviously have been invested in the stock market have been very pleased with their returns over the last year or so, really a couple years, but obviously this has been a great year, multiple all-time highs. What are you seeing when you look at this, chart? And overall, I've been hearing more and more people say, hey, we're due for a little bit of a pullback. We're testing support levels, and we're maybe going to, see some of those get retested over and over again, and we might see some pullbacks as a result of it. How strong do you see the overall S&P 500 right now? And what do you think, let's call it the remainder of the quarter and heading into the rest of the year is going to look like for the S&P 500 based on, what we've been looking at, what we've been seeing? Obviously, year to date, we're at 11.6% up. The last year, almost 20% up. I mean, it's been a great run. So are we due for a pullback, or do you think it's going to be range bound, chop sideways, still hold its support and continue to climb up as we go into the end of the year?
Well, I was saying that we were going to be somewhere around the 78 range year end. That was my price target. And then, we had middle of the year after that dip in late spring, a huge rally. We were in the 78, 77 zone. And then we've kind of been just chopping around the 76, 78 zone for a bit. I think that we'll get some sort of relief rally when if we have any sort of news that's positive on Iran. This last week, we had a lot of leaders in Iran, including I think it was the Ayatollah's oldest son speaking in front of the parliament equivalent there and essentially saying, hey, we need to surrender and get this thing kind of moving in the right direction because things are not looking good. And he said that on live television in front of all the current leadership. So I think that was a positive. But really, we just need keep inflation data coming in good, GDP numbers coming in good, earnings coming in good. That's going to keep the market moving in the right direction. I think it's going to be choppy still for the next couple weeks, but we have something really cool in the next about 2 months. We go into the fall season, which is heavily earnings based, and we kind of missed the Santa Claus rally last year, and so we might be due for a bigger one this year, maybe from a sentiment perspective. But I'm looking forward to easing up on interest rate costs so we can see more positive sentiment from retail investors, because right now that's kind of what's pulling the market down is retail investors still hold a lot of cash on the sidelines.
Let's talk about some of the large cap stocks real quick before we move on kind of from the market here. We've got, all of our big recognizable names. Are there any here that you think are good buys right now? And obviously, again, none of this is financial advice. I'm just curious. So like when you're looking at, some of these large cap stocks and companies, what are you looking for when you are kind of analyzing, hey, there's, a potential good buy here, or we've got our eye on this stock for these reasons. And maybe on the opposite side of that, like, hey, we're not buying at this stage. Here's why. How do you look at, call it these top 50, 100, large cap companies when you're deciding where you see some opportunity or where you want to steer clear of?
Yeah. A lot of data, stuff that's not shown here, but names up there that we are liking are, I know we love Google, we love Broadcom, we like Eli Lilly, we like Amazon, we like Microsoft. Those are all names that we own for most of our clients. Most of these lower names that we're going through, we don't have. We own RTX Corporation, quite a bit of it. We're kind of looking for companies that have potential to spring up. They're not towards the end of a movement. They have good earnings potential. Their price to book looks good. Their price to earnings ratio looks good. And a lot of the times it's based on what factor we're kind of investing on. Are we looking for quality? Are we looking for momentum? Are we looking for carry? Are we looking for equal weight? What are we trying to do? And right now I would say we're focused on carry and momentum the most. Momentum actually probably the most in our trade. So we're heavy tech, heavy in the names that we just mentioned. We have Apple, we have Nvidia, we have all those names. And then we have some other stuff on the back end like Lam Research. We picked up some SpaceX for some of our clients. We have Palantir. We have Palo Alto Networks. We have a lot of cool, more spicy things. But we buy typically large cap companies when it comes to the individual names and ones that we feel like we can go overweight. And another one we've been buying a lot of is Goldman Sachs, JP Morgan. Those have been 100+% returns for us, for our clients over the past years that have owned that. So those are also really good positions that we own.
Well, let's talk about crypto. Is the bear market over and has the bull market begun? Obviously, we know that Bitcoin is the space that most people, or the coin that moves the market. Mm-hmm. And it's been,
volumes been pretty crazy past couple days.
Yeah, volumes, ETF inflows, a lot of institutional buying and adoption seems to really be starting to take place. Let me see if I can zoom out here a little bit, and let's go to the last month.
Whoa. Oh my Lord!
Jeez.
You might want to go one notch down to week.
Let's go to week.
That's still a little wild.
Yeah, why is that doing that?
That's just that fun Bitcoin, baby.
All right. Well, what we do know is that it broke out of multi-month range.
Correct.
Which a lot of people were saying, hey, it's going to go lower. I think the lowest was 58, 50, just sub 58. And people were calling for lower. It had a nice little rally and jumped back up into the mid 60s and then was kind of range bound for, a good amount of time. And if any investor, knows when it's range bound for quite some time and it's compressing and compressing and compressing, it's either going to go up really fast or it's going to go down really fast, whichever way it decides to go. And of course, who fucking knows when you're, doing these things, right? I mean, you got a 50-50 shot at picking right. And it bumped up fast. I mean, I think it was one of the largest in its entire history. I think it was top 1 or 2 rises in Bitcoin history in the amount of time that it did. It peaked out at about 81,000. I think it's, right now we're seeing it at 78, 5. So this is something that a lot of people are, throwing around speculation that because of Trump giving guidance on the Crypto Clarity Act and really trying to push that forward, and that seeming to have some momentum. We've heard that for some time now, but we also know that institutions that talk shit on crypto, specifically Bitcoin and some of the majors, are now significantly buying into it. They're investing into it for them and their clients. And there seems to be more of a discussion around this narrative around cryptocurrency and the legislation and how that's really going to impact, regulation. And it being something that gives a lot more confidence to institutional capital to come in, which obviously previous, bear markets breaking out have really been driven by retail because there wasn't any institutional capital playing in those times.
Yep.
Is this time different, and do you think that the bear market is officially over based on some of the stuff you're seeing?
I think with the fact that there's so many ETFs now, I think to your point that you just made, what'll happen is when we get these relief rallies where people shift sentiment from fear to greed, kind of like they talk about in the stock market, I think you'll see the pop be a lot quicker. The thing that I'm keeping my eye on is the breadth of that, like the percentage of rebound keeps getting smaller and smaller and smaller and smaller, and it's going to continuously get smaller to where it compresses and gets more flat. So what does that mean? I don't think we're going to have these huge rallies in the next 5 to 10 years. I don't think they're going to continuously do this
to be as explosive.
Yeah, but that also means that we won't have these huge dips. Either the asset will stabilize itself more, but if institutions are forced to put, which they're not, they have no, it's not like the S&P 500 where that's what we saw with SpaceX, why the price was moving up so fast in the beginning. We had the ETFs and mutual funds had to buy it. They didn't have an option. We don't have anything like that with Bitcoin. It's a derivative asset. Its value is derived based on the underlying thing it tracks, which is just demand, volume,
supply and demand. Yep.
Yeah. So the benefit, I think, to what's going on now is it got back to a number in a sentiment way that was low enough where people said, hey, if I put $100,000 there, which I would never recommend doing that, but if I put $100,000 there, I get a Bitcoin and a half versus prior, at its high, it was like, well, I put $100,000, I don't even own one Bitcoin. And that sentiment is tough for people to get around. So when the price gets higher, the higher the price gets, the less and less and less volume demand it attracts that's non-institutional, because people see that and they say, well, I know it's still $50,000, it's $50,000 invested, no matter if I get a fraction or not, I get all the same movement. In their mind, they don't own a Bitcoin. So that's going to continuously be a problem as the price gets higher and higher. I don't know if it'll break out above its previous high. I think that's going to be really hard for it to do. But if it does do that, it'll be Crypto Clarity Act passed, tons of institutional money coming in, and the U.S. government gets their toe wet and starts buying as well.
I think your last point there is probably going to be the catalyst for whether Bitcoin hits new all-time highs, like real new all-time highs. I mean, it's crazy to, I see some people on the internet talking about in 5, 10, 15, 20 years, it being millions of dollars per coin. The only way that we're going to see it really expand to the level that I think most people hope that invest in it will, is if the U.S. government really gets involved at the level that would be required to take it to those heights.
Correct. And the people know the U.S. government is involved in it because we hold it in a strategic reserve style, but we essentially are holding confiscated Bitcoin. We're not buying any. With the U.S. government saying we're going to buy it and be an active player in the market, the largest stock market and the largest economy in the world, that would bring huge bullish sentiment, not just from U.S. buyers, but that
worldwide.
There you go. That's what it would do. It would crack the lid off of an already worldwide used market. It would validate it, essentially. It would validate it. It would be a big enough player involved to where fear would hugely be subsided. And the only way that that's going to happen is if the Clarity Act passes. The U.S. government will not get involved in something that's not regulated. As far as purchasing, they'll hold, but they won't purchase.
Yeah. Well, going back to kind of tracking, right? I mean, you can see here the overall market cap of the entire crypto market was pretty flat for some time. I mean, if we come back to just looking at the year, I mean, this was, the peak up here back in October. There you go. It's 4.28 trillion.
About the size of Nvidia.
The size of the most valued stock in the world. It hit its peak, and then obviously the bear market began, and money continued to rotate out, and it's been looking to find its bottom. It had a little bit of a rally. Again, another dip here. And this is what I was talking about. It was range bound for, a couple months. And then as of this last weekend, it was really based on the Treasury buyback news. And Trump, I even think, mentioned that the U.S. government was thinking about getting into Bitcoin.
Correct.
So just little sentiments like that, but boom, it shot back up. So it's sitting at about 2.63 trillion. I will say this, based on a lot of the people that I follow, it looks like we are coming out of the bear market, but it's not necessarily confirmed quite yet. We start getting back up to these levels, I think we will, see the real bull market begin, and kind of the lower lows will start to become, lower highs, and therefore we're going to start to see, some of these other coins and projects and opportunities really start to benefit. So, I wouldn't recommend day trading these kind of things. Obviously very volatile and, risky. But if you're a believer in, buying low and selling high, and you know that this is where the peak of the market was at, and we know that it's way lower, even if it does go a little bit lower from here. I mean, we are at what? It's in somewhat of an extreme greed. And, a couple months back, it was extreme fear, kind of down in these sections. But if you're just somebody that believes in it long term, and some of these top coins that obviously are going to be around and benefit from the Crypto Clarity Act, then, dollar cost averaging into some of these types of opportunities, if you're holding long term, can be a great strategy when, you're coming out of a bear market. Nobody's going to nail the bottom. You've always said this, right? Like nobody's actually.
You always hit the bottom when you ain't aiming for it.
Yeah.
It's like almost impossible to hit when you aim for it, which is weird, but it's like you can hit. I've hit it twice in my career, like an actual market bottom, but I didn't know it was. I just was like, oh, okay, this is a good time to get in. I didn't say, oh, this is the bottom of the market, so I'm getting in. It was just timing was luck, and that's really all it is. It's better to just take lots of swings.
Yeah. Yep. All right, so for all my capital raisers out there, I know many of you, I mean, here at the end of the day, you need the skill no matter what. I mean, if you're going to raise money for a deal, for a business, a project, at some point in time, if you're swinging bigger than where you currently are right now, understanding how to raise capital and really what separates the people who get a lot of money that comes to them and the people who don't, it's a really important skill. And there's a lot that goes into this, of course, but there's really what I call the 5 non-negotiables. And the first one being, you got to build the relationships first. I can't tell you how many times I've gotten on a phone call with a prospective investor, but because of the relationships that I've built with them, they know my character, they know what kind of reputation I have, they know the deals that I've done. And a big part of that is this podcast, this show, giving people a window into who you are. And you don't need to have thousands of followers, you don't need to have thousands of downloads. But if you can give people a window into who you are, and whether that is in person, right, getting belly to belly, pressing palms, shaking hands, talking about the opportunities and just building those relationships, it's getting out on a golf course. That's one of my favorite ways to do it nowadays. Or, it's having some kind of virtual platform and a social media brand or a podcast. I can't tell you how many times I've gotten on the phone getting ready to answer questions and get grilled and talk about all the things that smart investors obviously are going to ask before they part with their hard-earned dollars. And they go, just tell me where to send the money. And I'm like, in my mind, I'm thinking, wait, don't you want to know more? Don't you want to ask this? And I can't tell you how many times people have said, I already know who you are. I already know what you stand for. I already have been listening to you. I've been watching your story, right? So for many of you, whether that's in person and building those relationships over and over, or it's through your content or social media, really important, just dig the well before you actually want to scoop the water. You don't want to start building relationships once you need the money. You want to have the relationships and have that Rolodex of people that you can go back with. Number 2 is, and this is a simple legalities one, but know what you can and can't say. I can't tell you how many people I say.
You see the thing posted up at the beginning of this show, right? I mean, like,
there you go.
We have to cover all of our bases too.
There's laws and disclosures, and the people who take it seriously and operate with integrity and do it ethically, and most importantly, if you're going to raise money at any point in time, my guess is you're going to want to do it again because you're going to be successful. And the last thing you want to do is to get yourself in any kind of hot water. So having an understanding of the disclaimers and understanding what you can and can't say, depending on how you're raising and who you're raising from and what you're raising for, just talk with an attorney and know what you can and can't say. Number 3, and this is probably one of the most important ones that I think a lot of people skip, is lead with the downside first, not the upside. Most investors want to know that you have taken the time to really do the due diligence and stress test your opportunities. What are the threats to your business? What are the risks with this real estate deal? What kind of buffers and safety nets have you baked in here? Where are you being ultra conservative versus a lot of the people that unfortunately raised a lot of money post-COVID when it was everywhere? They promised the world, blue sky everything, rose-colored lenses, rents are going to keep rising. No way is the, rate's going to hit 6-7%. We're good. And guess what, right? That happened. But if you were one of those people that went and said, hey, here's all of the things that we know could be a threat to your money and to this deal, and here's our plan if and when those things happen, you want to know the level of trust and credibility and authority you're going to build with those people. It's game changing. Like, investors know there's a risk anytime they part with their dollars, but they just want to know that you know and that you've got a plan for it too. So making sure that you're doing that instead of leading with, here's why my deal's so great and we're going to hit all these amazing IRR returns and it's going to be unbelievable, is a very different, especially for smart money. They sniff that shit out quick. Versus the alternative of you being conservative and having a game plan and stress testing your deals, a great way to build trust with your investors. Number 4, ask me how I know this. I learned the hard way, and it's something I'll never do again. Never pitch a deal that you are not in control of. Of all of the money that I've raised, tens of millions of dollars over the 16 years of investing, I pitched one deal that wasn't mine. And actually, that's 2, so I got lucky on the second one. Shout out to Green Coffee Company. But number 2 was I pitched a deal that I wasn't in control of. I was helping and consulting on it, and I was involved. But I wasn't the one signing the checks. I wasn't the one making the final decisions. I wasn't in control of it. And if that deal doesn't go good, guess what's going to happen? You're going to, 1, be hearing from your investors. You're going to lose trust and credibility and authority. And that was a hard lesson learned. And I want to make sure that any of you, raising money is about longevity. It's not about just winning on the first deal or one deal. It's about winning over and over and over again. And so making sure that you are protecting your investor capital is the most important thing, because if you do that, guess what? Once that happens and everything goes according to plan and you win for them, they're going to come back and go, when's the next deal? And here's more money. And almost every investor I've ever worked with, that's been the scenario. But what I can tell you is on that one deal, unfortunately, there are some investors that I don't blame them go, I'm probably not going to invest with you going forward. And that's something that you can avoid by making sure that if you die and your deal dies, at least you can say you fell on your own sword, that was at your own doing. But losing on somebody else's mistakes, it hurts and it's avoidable. Number 5 is communication, transparency, and accountability. This happens to be one thing that you'd be shocked at how many investors suck at this. We take your money and you get a quarterly email from us is kind of rare, to be totally honest. The amount of people who don't even communicate with their investors on a monthly or quarterly basis is actually a lot higher than you think. So one way to absolutely crush it with your investors, I've talked with so many investors that are in multiple syndications or with a lot of different operators, and they go, you communicate the most frequently to us. It's kind of crazy. I'm in X amount of deals and I barely hear from them. Or I send them an email and I don't hear from them at all. So if you can be communicative, ideally one time a month, whether there's no news, good news, bad news, the fact that you have a frequency of how you're training and teaching your investors of what to expect, and there's a cadence there, that builds trust, that builds authority, that builds credibility, and is something that the best capital raisers do. So those are the top 5 non-negotiables for raising capital. Build the relationship first. Know what you can and can't say. Lead with downside first, not upside. Never pitch a deal that you're not in control of. And communication, transparency, and accountability is the way that you win with your investors. And again, know that you're playing the long game here, because I have had investors who have started with 50 or 100K with me that now have $500,000 with me. As you go on in your journey, guess what? Other people go on in their journey too. And people who are of an investing mindset are in a mindset of making money. And as they continue to make more money, guess what they do? They look at their stable of people that they can invest it with and go, who do I trust? Who's doing deals? Who can I put this money with? And so over time, that money grows. I mean, I know you've experienced that with many of the people that started a small account with you, and then every time they get a big lump sum or they inherit something or they do, a deal that they get a payout on, what are they doing? They're coming back and stroking you a much bigger check than they started with, right?
Yep, I just did it like 3 times today and about 2 or 3 times 2 weeks ago. Family members passing, inheritance, retiring, selling of assets, it all gets reinvested.
Yep. So last one that I'll end on the real estate side, I have so many people that I talk to that think that the only way they can get into real estate investing, and when I say real estate investing, whether we're talking on a super small single family residence or a house flip, or you're going to run an STR and an Airbnb, or you wanted to get into a commercial deal, especially as you get into the higher rungs of real estate investing, it feels less attainable because the commas and zeros get a little bit more abundant and more capital is needed. So of course, the first way that you can own real estate is money, capital. You're stroking a check, and that's how you're getting a seat at the table, right? But the second way, this was one of the ways that I got into real estate investing, and it's a skill that costs you no money. And that is, if you can bring the deal to the table, if you can bring an opportunity to another investor who doesn't have access to the deal or isn't aware of the opportunity, I always say the deal is the little nugget of gold. And you're the one who went out and panned for that nugget of gold and you found it. And if somebody else wants to have a share in that opportunity, you are the one who has all of the leverage at the negotiating table. So of course you don't want to get greedy. And when you're first starting out, there's ways that you should structure it. But if you're the one who finds a really juicy opportunity, especially the better the opportunity, the more negotiating power you have, those are ways that instead of you just getting some little fee, you can say, hey, you know what? You would pay me this for this deal. I would love to keep that in the deal with you and have a little sliver of ownership. And guess what? Over time, you do that over and over again. You can get into real estate deals without having to use your own money, but you can leverage your skill set of being a great deal finder. This is something that I've seen people build literally 7, 8-figure portfolios with. And as you build more capital relationships and you become the guy or the girl that really understands how to find really great opportunities, the money is going to keep flowing. You find a great deal, the money will follow. Number 3 is you do the work. You are the operator. And there are people who like to write big checks that don't want to fucking do any work. And so if you can become an operator, a skilled investor that has a business plan, that has the deal, and you're going to go and execute and do all the heavy lifting and make them that money passively, that is another point of leverage that can allow you to get into ownership on a deal. And the last one, this is more for my high income earners or people with strong balance sheets, is your signature. Banks want people with liquidity, with high net worth. And as you get into higher tiers of real estate asset classes, a lot of the debt structures of these types of deals are non-recourse. So you're not signing over your life. And even if there is a deal where it is recourse, but obviously it looks like a great deal, you can get into an opportunity by just bringing your balance sheet, but not bringing any money. Or I've seen people sign on debt for $100,000, $200,000, $300,000. Hey, we need your balance sheet. We'll pay you as a way to get into this deal for ourselves. You can get ownership and we'll make you some money in the process. So this is something that you can also get into a real estate deal without necessarily having to bring any of your own money. If you can do all 4 of those, if you can bring money, the deal, the work and operate, and have strong balance sheet strength and sign on the debt, obviously you can own the whole thing. But the other side of it is you can own much larger assets and take a larger share and sliver of a much bigger pie, which can be very opportunistic. One of those types of deals can completely change your life, your financial future. And it's a great way to grow and build your network with other people that you're the yin and they're the yang, and you can continue to elevate each other together. So 4 types of capital and how you can use them to buy real estate. It's a great way that you can leverage that type of strategy. And just knowing that you have this capital in your pockets that isn't just money is a great mindset to have when you're looking at and you're approaching deals and you're thinking about how you want to negotiate and structure those with potential partners. All right, so as we wrap up today, what are you looking at as we close out the last month? We're going into September here. Does Labor Day kind of kick anything off as we go into the fall season, or
nope, just Jackson Hole, and then it'll be kind of till we get to earnings in the back half of the year into Thanksgiving, Black Friday, Cyber Monday. We see spending numbers come out. We see online purchase numbers come out. And people are then going to front run that, hopefully, for earnings for the beginning of next year. So that's what I'm really looking forward to now. I don't think there's going to be any rate cuts or hikes. I think it's going to be pauses. And I think that when War speaks, he's going to kind of indicate that through.
What a hell of a time to be, I was going to say real estate investor.
What a time to be alive.
What a hell of a time to be an investor in general. I mean, I just think about the technology, the tools, the communities. I mean, investing is getting fucking cool again. Like, investing kind of felt like it was one of those things that was out of reach for a lot of, like, unless you were a Wall Street person or you were wearing a fucking 3-piece suit and walking around with a briefcase, like it was just a foreign world. You can reach out and touch investing now in more ways than you can think of. And so the opportunity to build wealth right now, I mean, one, it's fun. It's available, but 2, I think also, 3, the most important thing right now is, like, from everything I'm seeing, you have to be investing. Like, you have to have a plan.
100%.
You have to be putting money to work every month. And that's ultimately what the most successful investors do, right? Is they know that the velocity of capital and keeping it working for them is the way that you continue to really take that next step. 5, 10, 15, 20 years of doing it, you're really going to be thankful that you did. And so I just, hope and urge people to keep innovating your investment strategies and keep leaning into the communities and the people, that are really equipped and capable and have the knowledge and resources to help you. I know that you do the free financial X-ray for everybody. So if you guys haven't taken advantage of that and connected with Ryan, he goes through your entire portfolio. They build a comparative portfolio of what they think maybe you could be doing better or differently. They look at all the fees that are in your advisors, little tiny fine print and oftentimes being overcharged. So if you guys want to connect with Ryan and his team, that's free, of course. You can text 844-447-1555. I know Tone put that up on the screen. Text XRAY, and that's a way that you can connect with Ryan. One of the ways that obviously I empower anybody in my network, it's how I've met so many of you, is by having you guys invest in my real estate deals, or now people investing in the debt fund, which we'll do a little breakdown on kind of what the debt fund is up to on the next episode. But if you're interested in becoming the bank and partnering with us and investing and leveraging debt onto collateralized real assets, that's something that we're doing with our investors, paying them out 10%. And that is the way that you can reach out. Text income to 844-447-1555. If you got money sitting on the sidelines and it's not earning more than, call it 8 to 10% right now, there's so many vehicles and ways that you can do put that money to work. And obviously this is one that we're offering out to our network. And if you're interested in being on the equity side and having a little bit more risk, but a little bit more upside, investing in commercial real estate assets, you can text the word deals to 844-447-1555. We'll have a great episode for you guys next week as well. Don't forget to tune in on Friday. I've got a solo episode that I'm dropping for you guys that I think will be really impactful for my active investors. So we'll see you guys on Friday's episode. As always, keep investing in yourself and your wealth on your march to $1 million and beyond. Peace.
Cheers,
see you guys.